Hey everyone. Before we get into today's interview, just wanted to drop a little reminder to stay up to date with all the latest episodes of On the Margin. You can subscribe to the Blockworks Macro YouTube. Just go up there, just click the little subscribe button, or you can click the links at the top of this episode. It'll take you over to Apple, Spotify, whatever your preferred platform is. Just subscribe there. And if you could, leave a rating and review. Really appreciate it. All right, on with the show. All right, everyone, welcome back to another weekly roundup edition. Wow, I haven't said that in a couple of weeks with my esteemed co-host, Mr. Mark Yusko. I missed you, buddy. How are you?
Missed you badly. And, between, vacation schedules and just calendars, it's been a while. So great to be back together. And unfortunately we have to do a shortened version today because of some other logistical challenges. So we're going to have to speed talk, so I'll do a speed reveal. So I do have the orange pants, and I do have the history of Bitcoin stocks. The change in the logo over time. I think we're going to talk history today. I was in Europe. You were in Europe. I think we're going to talk.
Men of culture. We're men of culture.
Culture. There we go.
Yeah. Well, I will say I'll give a very quick recap. There was a conference that went on last week called ECC. It's been going on for about 3 years. This was within the overall universe of crypto market conferences. This was an enormous outlier. And the reason why is conferences are a lagging indicator when it comes to crypto. The example I'll give is Consensus, which is the major one. And it was the 2018, 2019 time period. Market turned over in December 2017. 6 months later, they threw their biggest conference ever. Everyone was saying, what bear market, yada, yada. 1 year after that, 18 months in, brutal. Attendance down 90%. Organizers took a bath, all this stuff. So this year, that's what I was expecting. We're about 18 months in. Actually, timelines align almost exactly. Attendance year over year doubled. The vibe was higher than it's ever been.
Yep.
The solutions that people were proposing to problems were real. There was a genuine air of excitement and optimism, which was very lacking. And the stuff that people were solving were gigantic infrastructure bottlenecks that have strangled new app development for a very long time. So it's just a very encouraging week overall, I would say.
Yeah. Well, what's interesting about that is, again, history, old. That is the way it goes in downturns, right? Downturns produce the best companies, the best returns for investors. Now, no one actually ever gets those returns because everyone runs to the sidelines. Like literally, the reason I think, especially in my world in venture capital, why these are such good vintages is there's just no money. And so you have to choose amongst the projects. And so you really only fund the very best projects as opposed to at the top where you're funding everything. You just don't, and valuation doesn't matter and people do stupid stuff. But the building that goes on at these troughs is unbelievable. And people have heard my story about the Sienna guy in the 90s. And I can give you lots of examples in 2001. And I can give you lots of examples in 2009. And here we are in 2023, same thing, right? Same kind of, to your point, feelings like, wait a second, attendance should be down and people should be moping because we just, fell 75, 80%. Nope. Builders get more focused. Part of it is you don't have any choice, right? Because people
don't have any choice.
Yeah.
And necessity is the mother of invention.
Exactly. So I am, more excited than I've ever been as an investor. I mean, it was close in that bear market and the digital cycle is shorter, right? It's a 4-year cycle instead of a 7-8 year cycle in the normal business cycle. So I was pretty excited in 2018 when we launched and early 2019, and just things were just awful. Yet we just kept meeting people, building amazing things. And that fund is going to be our best fund by far.
Except I think for the one you're doing now.
And I think the fund we're raising right now will beat that. I really do. I think that fund is going to be our best fund, and that's not promissory. So don't come at me, SEC. I'm not promising anybody in. I'm just saying based on my understanding of history and my experience. It's not just understanding. It's not just reading about it. I've lived it, and I've seen when I was talking to a serial entrepreneur yesterday, and this guy already started one business. So he sold his part. I mean, the company's still going and it'll be fine. But he decided he wanted to go a different direction. And he's putting together a dream team of engineers. And that's what I love about this. He's not putting together a marketing person and doing an MBA pitch deck. He's pulling together engineers. And to your point, they are re-engineering a big choke point, not just in crypto, not just in trading, little coins, but in actually how workflow exists. And they're using digital asset ecosystem and blockchain to solve real world problems. And this goes to, while we were talking, we skipped last week, but the week before when I was still in Portugal and we were talking about, the Knights Templar and how they invented fractional reserve banking. And it's not just getting rid of the result of that, right? Which was this $7 trillion of friction every year for the trust industry. That's big enough. But now we're actually innovating. And now we're getting to what happens when you take away, I won't call it wasted money because I don't want to call banks and insurance companies a waste, but it's an inefficiency. When you liberate, and I use that word intentionally, right? When you liberate that capital, what happens is human beings get creative.
Yeah.
And human creativity, it's the superpower, right? There are a lot of things that that is the superpower, human creativity.
Yeah, and that I want to move on to the FOMC here, but just to that
the antithesis of creativity.
Yeah, that idea of having to choose at the VC level is exactly what happens at the entrepreneurial level of in a bull market, everything's working. So you get this weird positive signal bias where, hey, maybe we should try this. Oh my gosh, this really works. Is there a real business here? No, there actually isn't. So when nothing's working, you actually have to prioritize what is the most important thing to do. Let's talk a little bit about the FOMC. Kind of a slow one this week. To be honest, we got our 25 basis points that had basically been 100% priced in since the beginning of this month in July. No one really surprised there. What I want to immediately direct everyone's attention to is I think that what the market was looking for here was not so much what was going to happen at this FOMC. The market is doing what it's been doing, frankly, this entire year and trying to look and see through what the Fed is saying towards rate hikes, which Powell directly addressed and said there are no plans to do any rate hikes for the rest of this year. He also said some interesting things, Mark. He said that he's not expecting a recession, which was a pretty bold statement from the chairman of the Federal Reserve. He also said he doesn't see the inflation target getting down to 2% until 2025. So those are sort of two of my big takeaways from the FOMC. What do you think?
I think that's a great summary, and I probably wouldn't add much to that other than violent agreement. I think I will make one caveat. That the FOMC, right, which is not just one guy or gal, but it's hundreds of very highly educated PhDs, on paper, very, very smart, right? And they've been predicting those two things, GDP and inflation, for dozens and dozens of years, right? Here's the crazy stat. I mean, this is a crazy stat. They are over on those predictions. Like literally 0 for like 286 or whatever it is on the quarterly. I mean, it's you could flip a coin and be right half the time. They're horrible at that. So his commitment to say, I don't see, not commitment, but him saying, I don't see any more rate hikes, I'll take that as signal. Him saying no recession and inflation not coming down, noise, right? This is a guy who said inflation is transitory when it was 2% last time on its way to 7. And now that it's fallen from 7 to 3 and probably heading for sub 2, probably even, I don't know that we'll get all the way back to deflation, but there are some things that are looking pretty ugly. So I don't take his proclamations there with that much seriousness.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. Yeah, I tend to agree with you on that. And not so long ago, Mark, it probably rewind the clock back a year. I remember reading a survey from economists polled by Bloomberg, 100% of whom were expecting a hard landing.
Yeah.
It's just tough. And, as an observer, to, I guess, just put the caveat in, these are very, I guess every time is unprecedented times, but these are particularly difficult to forecast. But it's sort of like, which one are you supposed to take seriously? The 100% hard landing? Or now it looks like we're in this, the talk is, are we in this Goldilocks sort of zone? And I have two explanations for this, and I'd love to see which one resonates more with you. And
I'm psyched that you have two, because I think when I was talking to somebody this week, and they asked me, hey, you were more in favor of recession, and now it sounds like you're saying you're not. And like, yeah, I was just wrong, right?
Yeah.
Oh, what do you mean? Like, wrong. I mean, it happens, right? Actually, happens a lot. I don't like
happens all the time. Yeah.
But that's just life. And I really am struggling here, because the stuff I see with my eyes, the anecdotal evidence, full restaurants on vacation, full airports, Taylor Swift grossing $1 billion on this tour. The estimates are that she's going to gross $1 billion and set the all-time record. Wow.
Wait, Mark, sorry, can we just comment on the fact that Taylor Swift got a shout out from one of the reserve banks about her impact on the economy?
Yes.
Hold on. I got to pull this up.
No, absolutely. She made it into the minutes, the Fed minutes.
Look at this headline. The Federal Reserve says Taylor Swift's Eras Tour boosted the economy. One market research firm estimated she could add $5 billion. Yeah, she made it into. Wow, I think she's really made it now. Now the Fed's commenting on her.
And so when you look at that anecdotal stuff, it's like, wow. But when you look at other stuff, like, credit card debt, multiple expansion, right? Stocks have not gone up because things got better. They didn't go up because earnings went up. They didn't go up because they went up because the multiple went up like a lot. I mean, Amazon is selling at over 300 times earnings. NVIDIA is over 200 times earnings. I mean, these are, well, the 300 is actually unprecedented. The 200, we had that with Cisco in 2000, but 300, I didn't know what to say.
So let me lay a couple of theories out for you here. I actually just got reminded of, I think there are like three sort of possible explanations. One is a simple one, which is this entire market rally is basically being led by 7 stocks, and there's an AI narrative. So like you could simply take a look at the indices. You could say, hey, this is really like 7 stocks that are driving this. In your words, lack of breadth equals depth. This is probably not going to last. Yep. Here's one slightly less, actually also sort of bearish on a midterm time frame. I'm reminded of this story that Stan Druckenmiller told about his escapades trading the .com bubble and then crash, where he got in early, sold at probably the right time, made a tidy profit, got so sick seeing other people continue to make money, bought the top, took a bath, lost, within the over $1 billion, took a hiatus, came back. When he came back in 2001, the top had rolled off over the bubble, but there was a face-ripping bear market rally. And he
Yep.
kind of came back. There was a face ripping bear market rally at the same time. Gold or the dollar and oil were extremely strong, and earnings were down. And he just shorted it and made it all back.
Yep.
Part of what this could be, why is everyone so confused? 2022 was one of the worst years for the 60/40 portfolio in recorded history. Some
Yes.
amount of mean reversion was always going to happen. Bear market rallies happen in very big ways, and it's very confusing for people who participate in them. That's what this could be before we roll over, towards the end of this year. That's another bearish explanation.
Yep.
The short to midterm bullish, long term extremely bearish explanation could be what Lynn Alden gave us on the show a couple of weeks ago, which is that despite what the Fed is doing, on the fiscal side of things, we are running a $2 trillion per year deficit. That means the government spigots never turned off. And actually, we're stimulating, compared to how you would describe it in traditional economic terms, to a crazy degree. And maybe that's the reason why the economy has been so resilient. What do you think about any one of those? I mean, they're not mutually exclusive, but
No. Look, I think the last one is the most compelling
yeah,
in
me
the
too.
sense that, and you couple it with monetary policy is actually expansionary as well. People are like, no, he just raised rates. It doesn't matter what you do with the short-term interest rate because
Yeah.
you and I don't borrow at Fed funds. Banks borrow at Fed funds. And higher Fed funds actually makes banks more profitable. So, and if banks are more profitable, they can buy more stocks on their balance sheet, even though they're not supposed to, but they do. So that helps with the Ponzi of higher stock prices through multiple expansion. But the point is really, really well taken in that not only is the government fiscal spending really high, and particularly high in the defense sector, shall we say, that it just turns out a lot of our congressmen and senators own stock in these companies that are, they're voting to give money to Ukraine, who then gives it back to U.S. defense companies. In fact, I think it was Mitch McConnell said, you shouldn't worry about us giving money to Ukraine because it's coming right back. Like that's money laundering. That's not good, Mitch. Don't admit that out loud. But he did. And so that's real, right? That is real government stimulus because those are American companies with American jobs, and people then go out and buy Taylor Swift tickets for $253 on average. Some
Yeah.
significantly more than that. But the other piece of it that's gotten lost is M2 ticked up. It ain't going down anymore. No more reducing the balance sheet. The whole, hey, we're going to reduce the balance sheet, quantitative tightening. You haven't heard the word quantitative tightening in months. No one's talking about it because M2 went like this. The bailout of SVB and the bailout of other banks. And look, banks are still failing, but the bottom line is monetary policy is actually expansionary, not contractionary, despite the rhetoric. And so I think those two things, and I think the monetary is important, but I think the fiscal is what's really being lost. 2 trillion is a lot of money.
This was really Lynn Alden's analysis, but it started to make an enormous amount of sense to me. And the reason why I
Don't
called it,
take credit for, don't give Lynn any credit. Good artists borrow, great artists steal. So
I appreciate that. Well, look, that the reason I called it short-term bullish, long-term bearish is because good in the short term, right? Like they're borrowing and stimulating the economy. But long-term, the problem with these sorts of prognostications is like the timing, Mark. I mean, frankly, people have been saying this for 40 years, and you've been way too early if you've been saying this.
But and by the way, do give Lynn credit. I love Lynn.
I love Lynn too. Yeah, she's the best.
I'm just kidding around. But
I know.
Picasso was right, and genius. And but I think this issue of timing is really important. And the only thing that matters in the system that we've created is the short term, right? It's the period, we'll call it 18 months of active duty, right? Where you're not fundraising for the next election and you're not, paying back the favors from the last election, where you actually have some work to do. And you're going to do everything you can as government officials to make sure that people feel good, right? That gasoline prices are low and that spending is high, and that people feel comfortable borrowing. And you got to juice when you can juice. And even if you have to pay the piper long term, they're like, well, I don't care about the long term. I won't be here, right? I mean, except some of the career politicians, but then they'll just explain it away.
Mark, let me just close this section out on the FOMC because I want to move on to big tech earnings with you. But there's actually a great you love a good mea culpa, right? And in this one, we've got one from one of the greats, Mike Wilson. So Mike Wilson was an absolute stud last year, being leading the street and being extremely bearish. He's the chief equity analyst for Morgan Stanley, for those of you who don't know. And he's just come out and said we were wrong. So he wrote to clients in a note on Monday, and the soft landing is now being priced in as the most likely global outcome. And my question to you here is not even whether or not you agree with this, but are fund managers going to have to chase here? Because at the beginning of the year, everyone was in cash, extremely bearish. Now people missed this rally, and at a certain point, now you're starting to see 7 months into this year, you're starting to get the Mike Wilsons of the world saying, hey, we were wrong. And there's only so long that you can be bearish when stocks are going up this month. So how much of the institutional capital on the street is going to have to flip bullish to chase this rally?
Again, really, really important question. And as you know, I think questions are way more important than the answers. So this is the question everybody should be asking. And again, anecdotal evidence says, yes, there is a chasing that occurs. Now normally it's late, like Q4, and that's part of the explanation of Santa Claus rallies, and also around the issue that mutual funds have to sell by October 31st. It's not December 31st. And so there is this downward pressure in mid-October. And then you get this, 30 days later, to avoid the wash sale, you get this increase. And then you couple that with a chase year. And that's why you get these big blow off rallies sometimes in Q4. One of the things about summer, right, is people go away. Like literally, I mean, you went away, I went away, people go away. And therefore less happens, volumes drop. And you've seen that in the stock market.
Yep.
And you get prone to squeezes. And so, the NVIDIA thing happened, and I've seen it a couple times with other companies that quote unquote made earnings, which we'll talk about in a second. I'm like, no, you didn't make earnings. You told me you're going to make $1. Then you told me you're going to make 50 cents. Then you told me you're going to make a dime, and you made 11 cents, and you call it a beat. That's not a beat. I mean, you told me you were going to make $1 not that long ago. So, but the street thinks a beat, and because there's no one in their seats, you get a big squeeze, and they happen. So what I think is actually likely is, I think there has been chasing going on, just in terms of short covering. People have had to give in. And the number of liquidated shorts this year is an all-time record. It's never been higher. So all that quote unquote cash on the sidelines, I think a lot of it is back in the market already. And yet I do agree with you that there's going to be some people that wake up here and they look and they say, geez, I'm 500 basis points behind. And in the institutional world, 500 basis points is a massive hole, because no one said we were going to be up 19% in the S&P this year. Not anybody. And somebody says, I did. Okay, fine. Show me the one person who did.
I'm with
I
you,
don't
Mark.
I don't think there are anybody.
Yeah.
So I am positive on your question that it could lead to chasing. Although I will also, I'll take the other side, which is there's another seasonal effect that occurs in kind of the post-Labor Day, where people come back to work. They kind of look at the markets and say, doesn't make any sense.
Haven't been doing so good.
Yeah, well, and they just look at it and say, this doesn't make any sense. And they actually sell. And so you get these cathartic September, October kind of downdrafts. And to your point, if if we think about the last tech bubble, right? 2000, 2001, 2002. So 2000 was not the big bad year. Everybody thinks of it as that's when it turned. Well, the market was only down 9%. It just wasn't even down that much. And then in first quarter '01, it actually rallied a decent amount. And then it fell off, and it was all Fed based because the Fed was going to save the day. And then it rallied hard into that face melter that Druck talks about, kind of right up until 9/11. And we were almost back to even by September. And then we had a pretty serious correction exacerbated by 9/11. And I think we were down 13, 14 for the year. But it was 2002. It was the bad year, right? That's when we found out WorldCom was a fraud, and that Enron was a fraud, and that Cisco had to restate all their earnings. So I think if you look at this one, if this was tech bubble 2.0, it's possible that we're going to play out that same way, where you have this relief rally. Now, the numbers are different in that we did have a really bad year in stocks in 2022, really good year in stocks this year, but net, you're still down, right? Over the period. If you're down 20 and up 20, you're still down. And then you could have the come to Jesus. And so I don't know. I would be more cautious than ebullient kind of coming into this September. I'm not saying it's going to crash, but I would say that there's a force countervailing against your chase, which I do think is probably going to happen.
Hey everyone, we'll get back to the show in a minute, but just wanted to let you know that we've got our permissionless conference coming up. This is the one that we do with Bankless. It is the biggest and best conference in DeFi. It's going to be in Austin, Texas this year, September 11th through the 13th. Now, you've heard me say this many times on our show before, but the time to be bearish on crypto was 18 months ago when the Fed began raising rates. Since then, our entire market is down more than 50%. We've had all this bad news. In the last 2 weeks, we had BlackRock and a whole slew of other institutional investors file for a Bitcoin ETF. This space is not going anywhere, so if you're interested in investing in this space at all, I highly recommend that you attend this conference. The other thing, and I've said this before as well, bear market conferences are the best ones. In the bull market, you have all this retail, all this noise. Now you only have the people that are really here building great products. This one is worth your time 100%. And since you are such good listeners to On the Margin, which I really appreciate, giving you all a special 30% discount code. It is MARGIN30. Now you can access that by clicking the link in the bottom of the show notes. So you can see my fingers pointing down, click that link. Because you are a listener of On the Margin, you get 30% off to the conference. Again, the code is MARGIN30. We'll see y'all there. So maybe we can close in that same sentiment on big tech, which we're sort of in the middle of earnings seasons here, which has been a mixed bag. So on the good side of the ledger, we've got Meta and Google, which both had big beats. We can go into some of those statistics. Big disappointments, disappointing earnings from Netflix and Microsoft. We've still got Apple and Amazon to report. Apple obviously being the biggie at almost $3 trillion of market cap. So I think I've got some. Yeah. So look at this slide here. This is family daily active people, DAP, whatever their metric is for Meta, which has just climbed to over 3 billion. And the way they divide up their different or report on their different lines of business is there's advertising revenue, which was a beat at 31.5 billion against 30.43 of expected. Family of apps revenue, 31.7 billion, beating estimates of 30.55. Reality Labs, which is their metaverse division, missed by almost 40% year over year, 276 against 391.9 expected. That is the one that is bleeding EBITDA, although Mark Zuckerberg has shored up, to some extent the bleeding there and assured investors, but that's still probably tough for them. And then the EPS, the earnings per share, is where they really smoke things. 2.98 cents or $2.98 versus $2.46 of expected. So, yeah, I mean, it was pretty good for the Metas and the Googles of the world. A little bit more mixed for the the Netflixes and the Microsoft. But the reason I think it's important to zoom in on these guys is they are what is driving the market right now. To that first point, I mean, it's really a pretty small number of companies up there in rarefied air that are dragging all the indices up
Yep.
and soaking up all the capital. So it's worth commenting on. I mean, I don't know if
It
you have any.
is, and it's self-fulfilling, right? I
Yeah.
mean, so much of the money has been gamified. And it's two types of gamification. You got the young gamification, the day traders, right? Now they're not really big enough to matter in terms of total dollars. Um, but it's real in the sense that here, my sign in today. So, but it's real in that they are driving what's happening in a big part of the investment landscape. Things like GameStop and even they even jumped on Nvidia, right? The day
Yeah.
traders jumped on Nvidia, but then you see it in crypto with Doge and that kind of nonsense. But
Yeah.
but that's real. But the bigger gamification is us, right? The boomers who put our money in these magic things, these magic bean growers called 401ks and 403bs. And every 2 weeks, money is taken out of our check and deposited into index funds. And index funds are passive, which means slow active, which means momentum. And so Apple is now 7.5 or something percent, and Microsoft is right behind. And so those two stocks, 15% of every dollar of retirement money is going into those two stocks, irregardless of the valuation, because
Yeah.
an index can't think. And that isn't going to get turned off yet. It is every year, right? Another number of us turn 71 and a half. I got a ways to go, hopefully. Well, yeah, no, definitely, but hopefully I make it that long. And, but every time you turn 71, then you got to start taking money out. And that today is about $1 trillion a year of outflows, but the inflows are still bigger. And so that is what's causing this. And at some point, you got to say, well, but okay, but someone's gotta stop it. Well, who has been the person or persons that stopped it in the past? Short sellers, people like Jim Chanos and others. Well, what happened to them? Most of them have been eradicated, right?
I know.
Literally take it
I
out
know.
back and shot. So there aren't that many left. They've been vilified. I mean, absolutely vilified.
Yeah.
And here's the part that is less talked about, but real. There used to be a an information network, and I'm not talking about anything negative or clandestine, but there was a really good information network of real information, like analysts at big firms like Morgan Stanley, we were just talking about, and others would actually talk to people, and then they would publish this research. But if you were a big client, you could get access to that first. Again, not in a clandestine way, but just look, if you're running a business and your best client comes in, they get to go to the front of the line. That's just the way it works. I
Yeah.
mean, we have velvet ropes for a reason, right? And
Yeah.
so,
Just like a
but
bunch of kind of like inside friends just trading around.
yes, just friends, just friends.
I was making a joke there, but
No, I know what you mean.
uh,
Yeah, absolutely. Now there's instantaneous AI robots scraping everybody's sentiment on Twitter, and that stuff, it's exacerbating these trends. And so I feel like we've got this technological tidal wave of it's the old adage, do more of what's working and less of what's not.
yeah.
It used to be really hard to do that because you actually had to commit to do it, and then you do it and it wouldn't work the first time and you'd have to commit to do it again. Or it would take time to actually work. Here, it just works instantaneously because there's just everything's so fast and so big. And so there's nobody that can change. Like NVIDIA, there's no way you should pay $220 for $1 of earnings. no matter how fast that earnings is growing, no matter how big AI is. We've talked about C3 AI, right? And this guy's laughing. He's probably not listening to this, but this guy that, told me it's going to go to the moon. It's going to the moon. I'm like, what are you talking about? They faked all the data. They got this big Air Force contract and they faked it. And that now has come out in a court case. This former employee said, yeah, we faked it. And the stock won't go down because its ticker symbol is AI. They incinerate cash. They literally burn $150 million a year. So they've burned almost $750 million in their life. And the stock is up like 300% this year. That's insane. That's literally insane. But what stops it? Because a short seller that tried to short that has been carried out. And the only thing I can compare it to is MicroStrategy. First iteration. MicroStrategy was the $3 stock in 2000. It went to 100. And all the short sellers got carried out on a stretcher. Literally. And they came back. And it went to 200. And they all got carried out. They came back for a third try. It went to $330 at the peak. $330. Okay.
This is what is it at now?
And then it went to 3. It went from 330 to 3. Michael got fined by the SEC for fraud, for making fraudulent statements, cooking the books, had to pay in the paper, had to actually admit guilt this time. Usually you pay a fine, you don't admit guilt. I'm like, if you pay a fine, you're guilty. But he actually had to admit guilt. And he went underground for 20 years before he became, Bitcoin Messiah. But that story is just so, and I'm not saying Google is that. I'm not saying Amazon is that. What I am saying, NVIDIA is that. Those are real companies doing real things. What I'm saying is we're in that mania phase where we have total willing suspension of disbelief. We really believe that Tom drove off a cliff instead of a giant ramp with safety stuff. But he still drove a motorcycle off a ramp and with a parachute. And it's an amazing scene. It's pretty cool.
Yeah. Actually, I was looking it up, Mark. You had the story right there, but the amount that MicroStrategy pumped actually wasn't to 300, it was to 3,000. Which is pretty, yeah. It went all the way down to $3. Right.
Yeah, split adjusted. I forgot about that.
Got it. So, it's funny. And, I actually remember a friend of mine, this must have been, when I was first starting to work at like 2016 timeframe, 2017. And I remember, she was saying, oh, I work at this hedge fund called Kinekos. I was like, oh yeah, Jim Chaino, I've heard of that. It's a very famous fund. And she's like, yeah, he really doesn't like Tesla. And if you remember back to that time frame, Mark, people have been short, the smart money hedge fund short guys have been, anti-Tesla for frankly almost a decade. Yeah, I know. I know.
Look, we thankfully we covered at 300.
Yeah.
Right? We went short at 200 and it went to 300. And I remember having a debate with the guys. They're like, it can't go any higher. I'm like, no, it can. It shouldn't, but it can. And, thankfully we didn't stay short. But look, there are times, and I think we're in one of those times, where the more logical you are, the worse it is for you. And
Mark, I'm so with you. That is an oft understated, I think, what you want. My theory on like people who like gold and Bitcoin is, they often get, and honestly, sometimes I get in this bucket when I get a little more frustrated with this particular group, but it's like, you want the world to burn, right? But I really think what it is they want consequences to actions. And the reality is in this era of like QTs or QE, ZERP, sort of weird monetary policy where there's an explicit thumb on the scale, it does not reward good behavior. And that is psychologically taxing. That is a frustrating environment to be operating in, because it's not 1 year or 2 years that there are these market distortions. It is many, it is decades. And it's frustrating. It's a frustrating, yeah, it's
It
psychologically
is. Look, it's
taxing.
what's really hard is when you do logical things for a living, it makes it even worse, right? If you work for a Momo fund, you think this is the greatest thing ever. Because look, there's nothing wrong with momentum. It's one half. Like, I would say you're either genetically a value person like me or a Momo person. It doesn't make you good or bad. It's like being introvert and extrovert. It doesn't make you good or bad. It's just how you charge your battery. So, but they're fundamentally different. Like, you're never going to make me an introvert. I am never at the end of a long day going to go sit by myself with a book. That's just not going to happen. I need people to recharge my battery. And again, that doesn't make me a bad person or a good person. It just is. And so if you're a Momo in a Momo world, life is awesome. And you justify well, we all do this, right? When things are working, you say, oh, look how smart I am. And when they're not, you're like, oh, the market's broken. It's not that the market's broken. It's just we're in this phase. Look at M2. It's going up. And when M2 is going up, guess what happens? Stocks go up. The other thing that happens, Bitcoin goes up. Bitcoin's up this year a lot. Not because Bitcoin got better. One Bitcoin still one Bitcoin. What happened? The dollar got worse. The dollar got worse, right? The fact that tickets to T-Swift cost, in some cases, thousands of dollars is not because the music's better. It's the same music. And maybe as a performer, she's gotten better. I don't know. I haven't seen her, but it's not that, right? No, I'm serious. Maybe, and I don't mean better like she was bad. I mean, she may be like Celine Dion, like quality. I mean, like where people are just,
I think at some point she's like becoming one of the best sold artists of all time. I mean, she's got to be up there at this point.
No, that's my point, right? Bruce, he got better and better and better as a performer. Like when he was just from Asbury Park, he was good. He was good, but he became a performer, right? He became this amazing, and I think he has the record for the tour that she's about to break. And, but what I mean is Madonna, right? When Madonna was first singing, she was just some, funky kind of created image with the lingerie and all that. So she was a spectacle. But then she became a performer. I mean, her height, those concerts were unbelievable. They were spectacles. So I'm not saying she was bad. I'm just saying, maybe she's getting a little bit better, but Bitcoin doesn't get better or worse. It just is. It is the perfect money.
So we've got to close here, Mark, but where do you want to guess? Now, this isn't one-to-one, right? Because the way music used to get bundled up into records is different from how it typically gets sold today. But trying to normalize out that data, where would you say Taylor Swift is relative to best-selling artists of all time? Like on a 1 through 100.
Artist of all time?
Yeah.
I mean, she's like, in the second 10.
Yeah, you're absolutely right. She is 12.
Yeah.
12 best-selling artists of all time.
Yeah.
Congrats, T Swift. You're crushing it. You're I honestly nothing but respect for you. $1 billion tour, like Jesus Christ, good for you. Mark, this has been a fun one. It's been good to do this again. I've really missed this. So
I know.
Will see you,
so we'll get back on schedule here for the fall, and before you know it, we'll be talking football. So
yeah, and permissionless as well. I will see you in person.
There you go.
Very soon down in Austin, Texas, baby. That'll be a lot of fun. Cool.
Barbecue on me.
All right, Mark. I'll talk to you soon.
Have a good one.